Hello, I'm Tiaan Herselman from Old Mutual Wealth. And amidst all of the noise, uncertainty, market volatility, every single headline and adjective that you can think of, I thought now would be a great time to sit down with our chief economist at Old Mutual and good friend of mine, Johan Els, just to give clarity and create some context for what's happening at the world. And Johan, things seem a little bit volatile at the moment. What's going on? How would you summarize the events taking place at the moment for those of us who've been living under a rock?
Tiaan, absolutely. I think exciting times for an economist, but certainly people are worried and concerned. And I think back to the global financial crisis and I think back to the COVID crisis. And there's certainly opportunities out there. But I think it's important to get the perspective. What's happening around the tariff war that Donald Trump started earlier and exacerbated last week with Liberation Day? What's the impact on the US economy and on the South African economy? And I think there's some valuable lessons for us in terms of what it means for investors, but also in terms of what can happen in South Africa, in terms of the rand and interest rates, perhaps.
Now, Johan, you mentioned the US. Now, even though we are all the way down south in Africa, as South Africa, the US has a big impact on not just us, but the globe. But what do you think will be the impact of Trump's policies on the US over maybe the short term, but also maybe medium and longer term?
Yeah, Tiaan, absolutely. We're such a small and open economy, so what happens in the US impacts on us. But to see that impact, first, as you say, we have to look at what's happening in the US. So firstly, no matter the level of the tariff, but I think the uncertainty created in the US by this on-again and off-again tariffs, whether it's significant or only 10%, but it's that uncertainty that impacts severely on the US economy. Just imagine if you're a consumer or business owner, if there's uncertainty, you put on hold any kind of spending decisions, whether it's hiring new employees or investing in your business, or as a consumer, why would you buy a new car or new house now if there's that uncertainty? So on top of an economy that's already been slowing for the last 3 years, now there's uncertainty. So my view is that the US is heading into a recession. Whether it's the huge tariffs or put on hold for 90 days and just 10%, the US is heading for recession. That means even the inflation uplift we expect in the US for the next few months because of those higher tariffs will likely be muted down the line because of a weaker economy. And I think that's crucial. That's the focus of the Fed. So I think the Fed will start cutting rates from mid-year onwards, perhaps substantially, perhaps front-loaded as they usually do to protect the economy. But I think we can talk about 100 to 150 basis points of rate cuts in the US over the next 6 months or so. That in combination with a Europe that seems to be spending more, trying to support the economies, not only defense, but also infrastructure in Germany, for instance, that relative change, that's likely to lead to even a weaker dollar. We've already seen the dollar drifting over the last few weeks in line with this uncertainty. And a weaker dollar generally should be good for emerging currencies and South Africa as well.
Now, Johan, we've spoken about the US context, and I don't want to put you on the spot, but the one thing I always love about your publications and communications is you like putting a probability on something. Where would you rate a US recession in terms of probability? And then almost my follow-up question to that is, what is the impact on all of this on our economy, us South Africans, and then maybe later we can even talk a little bit about investments.
Yeah, absolutely. So at the start of the year, perhaps that perspective is important. My probability for a US recession was only 10%, so very low indeed. And then through Trump's early weeks and that uncertainty created by his volatile policymaking, that has shifted towards 40%. But after last week's Liberation Day tariffs, and again, even if it's on hold, the probability is now above 60%. So that's my base case that we will head into recession in the US. That is an impact on the world, of course. But in terms of South Africa, coming back to that part of your question, less than 8% of our exports goes to the US. So there will be an impact, but it's not the significant impact we thought. And that's not going to fall to 0% overnight. And that's sector specific, mainly vehicle manufacturing and citrus farming, perhaps some of the wine industry. So it's specific sectors that might be hurt. So in South Africa, I don't expect a recession. We've got some benefits in terms of the advancement of policies here. Things are looking better than what they did in Trump's first presidency. So perhaps we're slightly better insulated. But then importantly, if we talk about a weaker dollar, that's going to benefit the rand. The rand is undervalued at the moment. The rand reacted as we saw over the last week. But I think it always comes back. Think back to the COVID crisis. And then in South Africa, inflation is well under control. Even over the last week, if the rand weakened, the oil price fell significantly more, and that outweighed the rand's weakness. So much so that we're heading towards another petrol price cut at the start of May. The rand oil price has come off significantly. So that helps. And if we then see that the rand starts stabilizing again, as I do expect it will, the Fed starts cutting, the Reserve Bank will have some room to cut as well. So if we talk about 100 to 150 basis point rate cuts in the US, the Reserve Bank is a little bit more conservative, and they will only likely cut around 50 basis points. So cutting less than the US will also help support the rand. But it's all beneficial to us. I don't expect a local recession. I expect better growth than last year, perhaps not as strong as what I expected a week or a month ago, but still quite decent. It's not an all fall down scenario.
Johan, you mentioned something very interesting, which I actually even wasn't aware of, and that's that we export less than 8% of our total exports to the US. Do you think that this puts us in a place whereby we start engaging with other nations, maybe the likes of BRICS, and we start setting up other sectors of trade into the future to maybe diversify? Because I think it is fair to say that with Trump in office, the US is becoming a bit more, not volatile, but maybe more unpredictable. The Trump presidency.
Yeah, good question, because absolutely. We've seen the example from China in the first trade wars in 2017, 2018, for instance, where exporters found other avenues, other customers, other countries that they can export to. That's natural, and I think that will happen in South Africa's case as well, where our citrus farmers, our wine exporters will find other ways of getting rid of their stock. Unless, of course, we buy up that domestic stock of wine at cheaper prices. But certainly we'll find other avenues, and especially amongst the BRICS nations, they're already some of our biggest trading partners, China for instance, where they've got more room to support the economy. So coming to that point, Europe and China, our other two big trading partners, I'm not expecting recessions there. So trade to them should be relatively stable. Tian, on that point, may I ask you, taking all of this into account, my view of the world as we see it playing out, but also the fact that we in a crisis, as we said earlier, COVID similarities there, global financial crisis. What does this all mean in terms of your role, in terms of the messaging to financial advisors and direct clients as well?
Well, I think that's a great question. And our question always to clients is, and to financial planners is, does your financial plan dictate a need for change? So if you've put together some form of financial plan based on your client's goals, incomes, expenses, that should be the dictating element for the client and for you as a financial advisor, not what's happening in markets. Because any financial plan, whether you've got R1 million, 100 million, 100 Rand, can be broken down into just four numbers. The first one is what's the capital you've got, the assets. The second one is what kind of a return can you expect in that capital? The third number is what kind of a lifestyle do you want the capital to sustain? And the fourth one is how long can the money last? And hopefully the money lasts a little bit longer than you. We tend to focus a lot on that second number, the return number. But there are so many other things that have a big impact in your financial planning, something called advisor gamma, tax efficiency, holistic asset allocation, your income withdrawal strategy, drawing from retirement funds versus liquid investments. So the question we should be asking right now as advisors to their clients is, has anything fundamentally changed in your life? If nothing has changed and you still need a well-diversified portfolio or a return of inflation plus 4 to 5, then this short-term volatility shouldn't really upset you. We've seen it in 2008, we saw it in 2020. And as we are emotional beings, every single time, Jan, I often phone you and go, Jan, this time we're still fine, right? We're still fine. And every time you tell me, Jan, markets go up, they go down. The main thing now is look at the companies you were still invested into. If you invested into Microsoft, into Naspers, into Checkers, do you see these companies still being here in 5 years from now? And if you think Checkers will still be here, and I, as a big Checkers 60/60 fan, I think they'll still be here. We use Microsoft Teams. A lot of this will be going out on Microsoft. I think they'll still be here. So ask yourself the question, will these companies still be here? Make sure you're well diversified, but go back to your plan. And if nothing has fundamentally changed in your plan, there's been no life change, then there's no reason to do anything at this point in time.
So, Tian, I think back to what we said earlier about the COVID crisis, and I just want to emphasize, I don't think this crisis is nearly as big as COVID or the global financial crisis. But having said that, what you're actually saying is sit on your hands, unless you see a buying opportunity.
100%. And the one thing we know from 100 years worth of economic data, whether we're looking at local equities, offshore equities, is that at no point have markets taken a dip and never come back. That means that every single company you invested into aren't going to generate any profits, they're not going to do any business, they're not going to grow in 5, 10, or 15 years, that is very unlikely. And I think you'll tell me, Tian, we're not there. So at this point in time, if I'm seeing markets dip 10 or 15% and I'm in a well-diversified portfolio, we're not talking about somebody who's gambling the world on one company or maybe on a cryptocurrency or on gold or on one particular stock. If you're well-diversified and you have some spare cash, our view has always been buy when markets are low, rather sell when they are high. But if you've got a long-term time horizon, there's no reason to do anything.
But I also got from your answer that it's always a good idea to check in with your financial advisor on a regular basis in any case.
100%. Remember, they are the custodian of your wealth, and they are looking at not just what markets are doing, they're looking at all these other elements in your financial plan. And there's various strategies that they have in their toolbox that they can look at in your portfolio, and those things have already been put in place. I think the worst thing that we see, and we saw it in 2020 on our platform, was how many direct investors went into cash. And then you remember 2020, we had a 30% drop. And then 2021, we had one of the best years on the stock exchange in 2021 again. Now, that same person that went into cash in 2020, I can guarantee you they're not doing the same thing now. And those are almost the best clients they have that have gone through this. And Jan, in 5 years from now, and 10 years from now, and 2 years from now, there'll be another crisis. You and I'll be having another conversation. And then I'll be going, Jan, are we still okay?
And we probably won't see the blips on the graphs for this crisis.
100%. And look, I think to your point, and I'm quoting you, Trump is an unknown. I think every morning Trump wakes up and he's not always sure what he's going to do, but markets just don't like uncertainty. That's why we see these big swings at the moment. But when you miss the 10 best days in the market, that wipes out half of your returns over 10 years. So we are seeing markets being very volatile just because they're uncertain, and you can speak to it even better than I can. So right now, our message is stick to your strategy, stick to your financial plan, because what your financial planner put together, unless there's anything fundamentally changed in your circumstances, the best thing to do right now, if you want to build wealth in the next 1, 2, and 3 years, is do nothing. Thank you as always, Johan, for the insightful insights and also for giving us a rational take on all the volatility and uncertainty. I think on behalf of Old Mutual, if nothing has fundamentally changed in your financial plan, there's no need to panic. This is all part of normal investment cycles. Stay invested, remain calm, and if you have any questions, reach out to your financial planner.